You are standing at the pharmacy counter. It is 5:15 in the evening. You are waiting for your prescription to be filled. The pharmacist said 10 minutes. It has been 15. You reach into your pocket and check your phone. There is an alert from your tax software. It says the IRS has flagged an issue with your most recently filed return. You read it again. You are 71 years old. You have filed taxes every year for decades. You have never been audited. You have never had a problem. And yet something on this year's return, one number, one line, one decision your preparer made that you approved without fully understanding, has triggered a review. The pharmacist calls your name. You walk to the counter. You pay for your prescription. But your mind is somewhere else entirely. You are trying to remember what was different this year. The IRA withdrawal you finally took. The Social Security income that was higher than usual. The small amount of interest your savings account paid. Any one of those could be the issue. And if you do not know which IRS rule you may have missed and what your rights are right now, a fixable situation can become a formal assessment with penalties and interest that follows you for years. Most seniors make one of 3 specific mistakes with the IRS that are completely avoidable. And they make them not because they are dishonest, but because nobody explained the rules in plain language. What a tax professional charges $250 per hour to review before this becomes serious is sitting right here. Stay with me. I am Jacob, and I reviewed the official IRS documentation on senior-specific tax rules, required minimum distribution regulations, Social Security income taxation thresholds, and the penalty abatement programs available to retired filers. Everything here comes directly from irs.gov and the Internal Revenue Code. Before we go through this, IRS rules that affect seniors specifically are updated quietly, and most retired filers do not find out until they receive a notice. Subscribe and turn on the notification bell so that changes reach you before they reach your tax account. And join our WhatsApp community, link in the description, where we share confirmed IRS and benefits updates the moment they are verified. Now let me walk you through the most costly IRS rule most seniors do not know, and exactly how to protect yourself. Here's what is actually confirmed under federal law. There are 3 IRS rules that generate the most costly and most avoidable mistakes for retired filers: seniors, immigrant seniors, and anyone on a fixed income who has multiple income sources in retirement. These 3 rules are the required minimum distribution rules, the Social Security taxation threshold, and the estimated tax payment requirement for retirement income. Most seniors know these rules exist in a general way. What most seniors do not know is the exact threshold, the exact deadline, and the exact consequence for getting each one wrong. And that is the gap that costs thousands of dollars every year. Here is what is being shared in community groups that is not accurate. There are posts saying that seniors over 75 are exempt from paying taxes on Social Security income. That is false. There are also posts saying that if you miss a required minimum distribution deadline by a few days, the penalty is automatically waived. That is not accurate under current rules without a formal waiver request. Believing either of these without verifying the current rules is exactly how a senior ends up with a penalty they did not expect and did not need to pay. Now let me walk through each rule and the exact protection at every stage. The first rule is the required minimum distribution, and this is the single most common source of IRS penalties for seniors. Under IRC Section 401A-9, if you have a traditional IRA, a 401k, a 403b, or most other tax-deferred retirement accounts, you are required to begin withdrawing a minimum amount from those accounts each year starting at age 73. This age was updated from 72 under the Secure 2.0 Act signed in December 2022. That minimum amount is called your required minimum distribution, or RMD. It is calculated by dividing your account balance as of December 31st of the prior year by a life expectancy factor published in IRS Publication 590B. If you do not take your full RMD by December 31st of each year, or by April 1st of the year after you turn 73 for your very first RMD, the penalty is 25% of the amount you failed to withdraw. That was reduced from 50% under Secure 2.0. If you correct the missed RMD within 2 years, the penalty drops further to 10%, but you must file IRS Form 5329 to report the missed RMD and request the penalty reduction. The penalty does not reduce itself automatically. The exact words to use if you missed an RMD and need to correct it are these: I am filing Form 5329 to report a missed required minimum distribution for tax year listed on your notice. I am taking the corrective distribution now and requesting penalty reduction under the Secure 2.0 corrective withdrawal provisions. File that form with your next tax return and take the missed distribution as soon as possible. Immigration and tax attorneys charge $275 per hour to prepare exactly this filing. You now have the same framework. Never assume your financial institution will automatically calculate and send your RMD to you. Some custodians offer this service, but it is not legally required. The legal obligation to take the correct RMD amount by the correct deadline is yours, not your bank's and not your financial advisor's. Missing it is your penalty to pay unless you act to correct it. The second rule is the Social Security income taxation threshold, and this is the rule most immigrant seniors specifically get wrong. Under IRC Section 86, Social Security benefits become partially taxable when your combined income exceeds certain thresholds. Combined income is calculated as your adjusted gross income plus any non-taxable interest plus 50% of your Social Security benefits. If your combined income is between $25,000 and $34,000 as a single filer, or between $32,000 and $44,000 as a married couple filing jointly, up to 50% of your Social Security benefits may be taxable. If your combined income exceeds $34,000 as a single filer or $44,000 as a couple, up to 85% of your Social Security benefits may be taxable. Many seniors, particularly immigrant seniors, who came to the United States as adults and receive smaller Social Security amounts combined with pension income or part-time work, assume their Social Security is not taxable because the overall amount seems modest. But it is the combined income calculation that determines taxability, not the Social Security amount alone. A small pension plus part-time income plus Social Security can easily push combined income over the threshold and make a significant portion of Social Security taxable. If this was not calculated correctly on your return, the AUR system will flag the mismatch when it compares your SSA 1099 against your return. Consider what happens when a senior does not know this rule. A 69-year-old naturalized citizen receives Social Security, a small pension from her former employer, and earns $400 a month from part-time caregiving work. Her tax preparer from her community charges very little and means well, but calculates her Social Security as fully non-taxable because the Social Security amount alone is below the threshold. The IRS AUR system compares her SSA 1099, her 1099-R pension form, and her reported wages against her return. It finds that her combined income exceeded the threshold by $11,000 and that 67% of her Social Security should have been reported as taxable. A CP 2000 notice arrives proposing additional tax plus interest going back to the filing date. That outcome was completely avoidable with one correct calculation. The third rule is the estimated tax payment requirement for retirement income. And this is the rule that generates the most surprise penalties for newly retired seniors. When you were working, your employer withheld federal income tax from every paycheck. In retirement, most income sources, IRA distributions, pension payments, investment income, rental income, do not have automatic withholding unless you specifically request it. Under IRC Section 6654, if your total tax liability for the year exceeds $1,000 after withholding and credits, you are generally required to make quarterly estimated tax payments to avoid an underpayment penalty. The quarterly estimated payment deadlines are April 15th, June 15th, September 15th, and January 15th of the following year. If you miss these payments or underpay them, the IRS assesses an underpayment penalty for each quarter you were short. The penalty rate is calculated based on the federal short-term interest rate plus 3 percentage points, and it compounds. The protection available to you is the safe harbor rule. Under IRS safe harbor provisions, you will generally not be penalized for underpayment if you paid at least 90% of the current year tax owed or 100% of the prior year tax liability, or 110% if your prior year adjusted gross income exceeded $150,000. If you can demonstrate that your total payments met one of these safe harbor thresholds, you have grounds to request abatement of the underpayment penalty by submitting Form 2210 with your return or as a standalone filing. The simplest way to avoid this situation going forward is to request voluntary federal tax withholding directly from your income sources. You can request withholding from your Social Security payments by filing Form W-4V with the SSA. You can request withholding from IRA distributions by completing Form W-4R with your financial institution. Requesting even a modest withholding amount from each source throughout the year eliminates the quarterly estimated payment obligation entirely for most retired filers. Here is your exact step-by-step plan to protect yourself from these 3 rules. Step 1. If you are 73 or older and have a traditional IRA or 401k, confirm with your financial institution right now what your RMD amount is for this year and what the deadline is. Do not assume it was taken automatically. Verify it directly. Step 2. Calculate your combined income for the current year. Your adjusted gross income plus non-taxable interest plus 50% of your annual Social Security benefit. Compare that number to the $25,000 and $34,000 single filer thresholds. If you exceed either threshold, confirm that your tax preparer is including the correct taxable portion of Social Security on your return. Step 3. If you receive income in retirement that does not have automatic withholding, IRA distributions, rental income, investment income, either make quarterly estimated payments by the deadlines or file Form W-4V and Form W-4R to request voluntary withholding from your benefit and distribution sources. Step 4. If you already received an IRS penalty notice for a missed RMD, file Form 5329 as soon as possible, take the corrective distribution, and request penalty reduction under the Secure 2.0 corrective provisions. Step 5. If you received a CP2000 or underpayment penalty notice, call IRS at 1-800-829-1040 and say exactly this. I am calling to request first-time penalty abatement for the penalty assessed on my account for tax year listed on your notice. I meet the eligibility requirements and I am requesting the penalty be removed. Step 6. If any of this is creating financial hardship, contact the Taxpayer Advocate Service at 1-877-777-4778 and say, I am a retired filer on fixed income experiencing hardship due to an IRS penalty, and I am requesting taxpayer advocate assistance. Here are the free resources that support everything in this video. IRS RMD information and publication 590B, IRS Gov, IRS Social Security Taxation Worksheet, IRS Gov Publications P915. IRS Estimated Tax Information and Form 2210, irs.gov, IRS Mainline 1-800-829-1040, Taxpayer Advocate Service, taxpayeradvocate.irs.gov, or 1-877-774778. Free tax help for seniors through the TCE program, irs.gov, VITA. Immigration and Benefits Legal Aid, immigrationadvocates.org. One important warning before I close. There are people calling seniors and immigrant retirees right now claiming to be IRS agents and saying that a missed RMD or an unreported Social Security amount has triggered a criminal referral and that immediate payment is required to avoid arrest. The IRS does not call you to threaten arrest over a tax filing issue. The IRS does not demand immediate payment by phone without first sending written notices. Every legitimate IRS contact about a filing issue begins with a mailed letter. If you receive a call demanding immediate payment to avoid criminal action, hang up and call 1-800-829-1040 directly to check your actual account status. Report scam calls at reportfraud.ftc.gov. Now I want to hear from you. Did you know about the RMD age change under Secure 2.0? Did you know that your Social Security income might be partially taxable? Drop your question in the comments below. And tell me, which country are you originally from, and which state are you watching from right now? Your question may become the next video on this channel. I am Jacob. You have rights in this country. Knowing them is not defiance. It is protection. Take care of yourself.